Hello, and welcome to Finance World, where we tell you what's happening right now. Unexpected occurrences have replaced the eclipse on the cryptocurrency market, shocking players in the sector. The Celcius network mystery, followed by Terra Luna's demise, has led to a great deal of distrust in the Bitcoin market. As of May 2022, the cryptocurrency lending firm Celcius Network LLC has over $8 billion in customer loans and $12 billion in assets under management. On June 12th, the company announced that it would no longer accept withdrawals from its platform due to extreme market circumstances. In mid-June, the disclosure that Celcius was stopping withdrawals worsened the adverse market circumstances and temporarily caused Bitcoin to trade below $20,000. As the Celcius tale has developed, several inquiries have been raised about the project, management, and the recent network-related occurrences. The Celcius network is a centralized platform that offers dividends on multiple cryptocurrencies and digital assets, including Bitcoin, Ether, and stablecoins. Despite positioning itself as a bank, the lending procedure seems to function like a hedge fund. Crypto lending is similar to the savings accounts provided by conventional banks, except that it uses cryptocurrency rather than fiat money. An investor establishes an account, deposits Bitcoin, and receives interest on the deposits, much as in a bank. Investors can fund their accounts with Bitcoin, stablecoins, or even less popular, more erratic cryptocurrencies. In a broad sense, protocols accrue interest in the same currency deposited, generating a range of sales revenue. Like other lending guidelines, Celcius makes variable annual return pledges, but its publicly disclosed interest rates only go up to 17% APY. Users can borrow money using the lending protocol and put up their cryptocurrency as security. Along with Celcius, other protocols have turned to centralized finance, a different approach from decentralized finance in which users continue interacting with a centralized intermediary. Celcius guarantees a specified rate if users want to deposit money on the site. The protocol generated much attention throughout the last couple of years, and the business prospered greatly. Notably, the company increased the size of its most recent funding round to a staggering $750 million in November 2021, valuing the company at just over $3.25 billion. However, Celcius acted unexpectedly. The network halted withdrawals and transfers, locking users out of their money as the larger market struggled with the bearish trend. Intriguingly, considering how the protocol's failure exacerbated the market crisis, many in the market have compared Celcius Network to Lehman Brothers. Since mid-June, withdrawals have been frozen, leading to speculation that Celcius is insolvent. S. Daniel Leon and Alex Mashinsky launched the company in 2017. As previously mentioned, according to data from the company, the lending protocol lent over $8 billion to customers. Following the recent withdrawal freeze, job cuts have also been announced by Coinbase, BlockFi, and Crypto.com. The market's bearish waves have been exacerbated by events occurring throughout the cryptosphere. According to reports, Celcius has retained the legal powerhouse Akin, Gump, Strauss, Hauer, and Feld, the financial behemoth Citigroup, and management experts from Alvarez & Marsal to investigate possible funding solutions. Despite consultants' and attorneys' advice to file for Chapter 11 bankruptcy on June 28th, Celcius management sought to avoid bankruptcy. The protocol has been experiencing a liquidity crisis for weeks due to recent network-wide rumors. Notably, the Celcius network has continued to pay weekly rewards despite pausing withdrawals 2 weeks ago, which has confused the cryptocurrency Twitter. Beyond its immediate effects, the recent Celcius problem has impacted the network's overall level of trust. Additionally, Celcius's position in the competitive market might significantly damage the cryptoverse. Celcius is one of the main lenders in this business, and if they begin liquidating, the same might contribute to negative market velocity and adverse social attitude. Several players and experts have previously argued that the most previous falls and the range-bound market trend might partially be due to corporate selling. In the meantime, the bigger market's negative trend has contributed to Celcius's tragedy, and it remains to be seen where the project will proceed. Following a big month of upheaval, the cryptocurrency business Celcius finally filed for Chapter 11 bankruptcy protection. Celcius announced its plans to restructure to increase wealth for all stakeholders. According to Celcius, the company has $167 million in cash to cover operating costs. CNBC reported that as of Wednesday evening, the company's attorneys contacted specific U.S. state authorities, according to a person who wanted to remain anonymous since the deliberations were confidential. Co-founder and CEO of Celcius, Alex Mashinsky, said in a statement that this is the best course of action for their community and business, and that he is convinced that this will be remembered as a pivotal time in Celcius's history, when responding decisively and confidently benefiting the customers and securing the company's future. Kindly like and share this video if you've been enjoying it so far. Also, please don't forget to hit the bell symbol on our channel and subscribe to receive fast notifications anytime we upload new videos. Let's get back to the video now. After incurring consequences from exposure to the now-defunct hedge fund 3 Arrows Capital, Voyager also filed for Chapter 11 bankruptcy safeguard last week. This Monday, a bankruptcy judge in New York froze the remaining assets of 3 Arrows Capital. The fund is now going through the liquidation procedure. It's also possible we'll see more Chapter 11 filings in the near future following this trend. Regarding the bankruptcy filing by Celcius, Joseph Rotunda, Director of Enforcement at the Texas State Securities Board, said that the present situation was anticipated and it doesn't put a stop to necessary inquiries. Despite the company's financial distress, we mentioned they will continue to look into it and keep fighting to defend their clients. CNBC contacted Celcius for comment, but they did not answer right away. According to the bankruptcy filing, the firm has more than 100,000 creditors who may be clients and loan counterparties. The Pharos Fund, situated in the Cayman Islands, has the biggest outstanding claim against it for $81 million. Alameda Research, a trading company owned by billionaire FTX CEO Sam Bankman-Fried, is listed as a creditor in the filing with a $12 million unsecured loan. In a statement from the Vermont regulator, Celcius's customers were not given important information about the company's financial situation, investing initiatives, risk factors, and capacity to pay back its debts to depositors and other creditors. The regulator also stated that the company's assets and investments are likely insufficient to cover its current liabilities. According to partners at Gordian Crypto Advisors and Georgetown law professor Adam Levitin, clients of Celcius may only be eligible for cents on the dollar. They may have to stay long to see their money again. The court could see customers who participated in Celcius's high-yield deposit offer as unsecured creditors. Also, according to Levitin, who also told BBC that he doesn't believe Celcius is the last cryptocurrency bankruptcy, the approach seems to be that a customer's cryptocurrency is essentially the company's property, and that as an unsecured creditor, consumers cannot get their bitcoins back. He said the tide is still receding, and they are waiting patiently to see how this will end. As we stated earlier, Celcius was among the biggest participants in the cryptocurrency lending market, with about $12 billion in assets under management and more than $8 billion in customer loans as of May. With 1.7 million members as of June, Celcius claimed it was in a competitive market with interest-bearing accounts and returns as substantial as 17%. The company would lend out customers' cryptocurrencies to borrowers eager to take it at exorbitant interest rates. Then Celcius would share a little of that money with its customers. Nevertheless, the industry's liquidity crisis caused the formation to collapse. A one-time investment manager filed a lawsuit against Celcius last week, alleging that the company failed to hedge risk, artificially increased the price of its digital coin, and participated in fraudulent activity. Finally, 6 state regulators have already started investigations into Celcius. Just recently, Vermont became the newest state to do so. According to the state's Department of Financial Regulation, Celcius used customer assets in numerous dangerous and speculative trading, lending, and financing decisions.